Welcome back to another video here on the ComLucro channel. Today we are breaking down one of the most powerful and widely used setups in smart money concepts, the Power of Three, also known as AMD. This is a framework that helps traders understand how price is engineered throughout a trading session and how smart money positions itself before major moves. In this video, we will explain what the Power of Three is, how to spot it clearly on the chart, and how to apply its rules with precision. We will also walk through multiple real market examples, so you can see how this setup plays out in live price action, and how to use it to build higher quality, more intentional trades. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before we begin, there is an important clarification we need to make about the Power of Three, also known as AMD. Especially when we relate it to proper Wyckoff methodology. The Power of Three was popularized by ICT, and the accumulation, manipulation, and distribution naming was simplified to make the concept easier to understand. Here at ComLucro, we are students of Wyckoff methodology, and we even have dedicated content and a full course on this subject on the channel, so we prefer to use the correct Wyckoff nomenclature. The strategy itself does not change at all, only the terminology used to describe the phases. It is important to understand that during a consolidation, you never know in real time whether it will result in accumulation or distribution. A consolidation only reveals its true nature after the next phase unfolds. Because of that, labeling a range too early as accumulation or distribution can be misleading. The correct way to think about it is that consolidation is neutral until the market shows its intention through continuation or reversal. What changes is the probability based on context. In a bullish environment, consolidations tend to act as accumulation or reaccumulation before continuation higher. In a bearish environment, consolidations tend to function as distribution before continuation lower. This mindset keeps your expectations aligned with market structure, avoids rigid labeling, and allows you to apply the Power of Three with clarity, flexibility, and proper Wyckoff logic. The Power of Three is a trading pattern that breaks down price action on the chart into three major phases: consolidation, manipulation, and continuation. The first phase is a consolidation, which can later prove to be either accumulation or distribution, depending on what happens next. During this phase, price lacks a clear directional trend and often forms equal highs and equal lows, building liquidity and stop losses above and below the range, depending on the time frame. This consolidation can appear in different structures, and on higher time frames, it usually forms a well-defined range. The manipulation phase occurs when price moves away from the consolidation through what appears to be a breakout, but fails to follow through. In basic price action, when price breaks below a support level, that level often becomes resistance and pushes price lower due to trader behavior. Traders who previously went long see the retest as an opportunity to exit, while others see it as a chance to enter short. However, when price fails to continue and quickly returns back inside the consolidation range, this movement is classified as a fakeout. This action is designed to sweep liquidity outside the range and trap breakout traders. Once liquidity has been collected, price typically expands in the opposite direction. This final phase is what we refer to as continuation, and it is where trade execution takes place. As traders applying smart money concepts, the objective is to enter after liquidity has been taken and stops have been triggered. In simple terms, the Power of Three framework describes a sequence of consolidation, manipulation, and continuation, with accumulation or distribution only becoming clear after the continuation phase unfolds. Similarly, in a bearish scenario, the market forms a consolidation followed by a breakout to the upside, which engages liquidity above the equal highs. If price quickly returns back inside the range, this signals a fake-out, and the power of 3 pattern completes with a sharp continuation move to the downside. So, how do we enter a trade using the power of 3 pattern? We aim to enter trades after the manipulation phase is confirmed. First, price must return back inside the consolidation range, confirming the failed breakout. We then mark the candle closes that define the consolidation area. For entry confirmation, we need a clear break and close back inside the box. The stop loss is placed above the swing high, while targets are set at key levels ahead of price. There are situations where price expands aggressively and the initial move is missed. When that happens, we wait for a new market structure to form, and then look for a pullback to enter at a better price with a balanced risk-to-reward ratio. In other words, we focus on continuation trades after manipulation, aligning with the dominant direction rather than chasing price. If we look at this price formation from an intraday perspective, the daily candlestick would reflect this behavior clearly. Price opens, forms a high, moves to a low, and then closes strong. The objective is to capture the largest directional move within the intraday range, using the power of 3 framework. Now let us move to the chart and review some real trading examples. It is important to remember that this setup is not limited to a single time frame and works across both lower and higher time frames. In this example, we are analyzing gold on the 30-minute chart. The market is forming a clear consolidation range with repeated rejections from both the top and the bottom, signaling liquidity being built above and below the range, which can later resolve as either accumulation or distribution, depending on continuation. If we are bullish, the idea is to wait for manipulation below the consolidation lows to engage sell-side liquidity, and then expect price to continue higher. If we are bearish, we look for manipulation above the equal highs to engage buy-side liquidity, and then anticipate price continuing lower. In both cases, the consolidation itself remains neutral until the continuation confirms direction. Let us see how this plays out. Here, the next 2 candles break above the equal highs, engaging buy-side liquidity and trapping breakout traders who believe the level had been broken. When price returns back inside the consolidation range, the manipulation phase is confirmed. From this point forward, we look for a short entry aligned with the expected continuation. In this example, we have a clear opportunity to open a short position at the close of this candle, expecting price to push lower. The stop loss is placed above the swing high and the target is set at 2 times the risk. As price expands lower, the power of 3 sequence completes with a strong continuation move to the downside. It is important to understand that, like any trading concept, the power of 3 should not be used in isolation. It becomes far more effective when combined with other smart money concepts. For instance, if a higher time frame supply zone were present at this level, it would add strong confluence to the setup, increasing the probability of rejection. The same applies to higher time frame trend context. If price is already in a clear downtrend on the higher time frame, this short setup gains additional confirmation by aligning with overall market direction. This is why combining multiple concepts leads to more structured, consistent, and informed trading decisions. Now, let us look at another example. Here we have pound yen on the 4-hour chart. From a price action perspective, the market was in a long-term downtrend, but recently failed to create a new low, which signals a loss of bearish momentum. This was followed by a break above 2 key supply levels, suggesting that demand is starting to take control and that a potential counter-trend scenario may be developing. With this context in mind, the higher time frame bias appears bullish. Let us now zoom into the 30-minute chart for a closer look. On the lower time frame, price is forming a clear consolidation range, with 2 rejections from the top and 2 rejections from the bottom. Buy-side and sell-side liquidity are resting above and below this range. Once again, the consolidation itself remains neutral, and we are waiting for a stop-loss hunt and a failed breakout to confirm the manipulation phase. Keep in mind that the higher time frame context is bullish, as discussed earlier. Because of that, we want to see liquidity taken below the equal lows, followed by a push higher. Let us see how price reacts. At this point, price breaks below the range and then pulls back toward the former support, which is now acting as resistance and getting rejected. This shows sellers attempting to push price back into the range. And if that attempt fails, it signals that buyers are stepping in and regaining control. Now that the manipulation phase is confirmed, we can plan a long entry at the close of this candle. In this example, we clearly have a consolidation phase, followed by manipulation, and then continuation to the upside. This highlights how combining higher time frame direction with a lower time frame entry strategy helps identify higher quality and more structured setups. Even as the initial long entry was missed, there were still opportunities to participate in the following bullish movement. If we look at the 1-hour chart, the conditions were also aligned for a long position using the same power of 3 logic. This 1-hour order block offered a strong area to consider an entry, and it becomes even more relevant when we notice that the price retracement also aligns with the optimal trading zone between the 61.8 and 78.6 Fibonacci levels, reinforcing how multiple concepts can converge across timeframes when market context is aligned. When testing any trading strategy, it is essential to evaluate its performance across different markets, including currency pairs, stocks, and cryptocurrencies. Market behavior varies based on volatility, liquidity, and session activity. So a setup that works well on one asset may behave differently on another. Testing across sessions, scenarios, and timeframes allows you to refine the strategy and adapt it to your trading style. Another important factor when identifying consolidation, manipulation, and continuation on a chart is the influence of trading sessions. Each session brings different levels of participation, which directly impacts price behavior. For example, on the Euro-Dollar 15-minute chart, the Asian session often shows slower price movement due to lower activity. Price tends to remain in a tight consolidation range during this period, which is important because it often sets the stage for the manipulation and continuation that follow later in the trading day. Now let us see what happens when the London session begins. Price suddenly moves higher, engaging the liquidity above the consolidation range as well as the Asian high, before quickly returning back inside the range. This clearly shows how manipulation often occurs with the opening of the London session, when volatility is injected into the market. After that, price continues lower on the opposite side of the manipulation move. The sequence we observe here is an Asian session consolidation, followed by manipulation as the London session opens, and then continuation as price moves lower. By understanding how these phases interact with trading sessions, and by aligning them with when liquidity and volatility enter the market, you can better anticipate price behavior and identify higher quality trading opportunities. If you find it difficult to identify consolidation on the chart, you can use equal highs and equal lows as a practical reference. The first step is to identify the overall directional bias and make sure you are trading in line with the bigger picture. If you are bullish, your focus should be on equal lows, which indicate that liquidity is building below a key area. From there, wait for a liquidity run below those equal lows. When price returns back inside the range, it confirms that the breakout was only manipulation. What typically follows is a continuation move in the direction of the higher time frame bias, allowing you to align your entries with both structure and context. The psychology behind this concept is that for continuation moves to develop on the chart, the market first needs to gather liquidity. Large participants require opposing orders to execute their positions, which is why manipulation occurs around consolidation areas. Price moves back and forth until enough liquidity is collected, and only then does the market expand in the intended direction. Using this same logic, we identify the phases as consolidation, manipulation, and continuation. The goal is to participate in the main part of the move, which typically unfolds after the manipulation is confirmed. And if the initial entry is missed, there are often additional pullbacks that allow for entries at more favorable prices, still aligned with the same continuation. It is also important to stay aware of the next key level on the higher time frame. Major levels have the potential to slow down or reverse price, so we must observe whether supply or demand takes control. Once that context is clear, we can continue looking for opportunities using the same structured approach. Finally, remember that live trading involves real money and real emotions, which makes it very different from paper trading or simulations. Consistency comes from following a clear trading plan and executing it with discipline. Your trading plan acts as a blueprint, keeping your decisions structured, even when emotions are present. Before we wrap this up, it is important to understand that the power of three is not an isolated concept. It is part of a broader framework built around liquidity, consolidation, manipulation, and continuation. While this model focuses on how price engineers liquidity before expansion, the same logic applies to other high-probability entry models that are based on pullbacks, market structure, and institutional participation. One strong example of this shared logic is ICT's optimal trading zone and optimal trade entry model. While the power of three helps us understand how liquidity is gathered and how continuation is prepared, the optimal trading zone focuses on where a pullback is most likely to end. Instead of chasing price or reacting late, this framework allows traders to align precise entries with the dominant market direction. So, what is ICT's optimal trading zone and optimal trade entry? This is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. Its goal is to identify where a pullback is most likely to end, allowing traders to enter with precision instead of chasing price or reacting late. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range. The optimal trading zone, located between the 61.8% and 78.6% levels, highlights areas where institutional participation is likely to return in the direction of the dominant trend. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-timeframe confirmation, this model creates a clear, repeatable framework for high-probability trade entries. Understanding how the power of three works reinforces everything you learn about ICT's optimal trading zone and optimal trade entry. Both frameworks are built around liquidity, inducement, and the way price engineers pullbacks before continuation. When you study them together, you stop seeing isolated setups and start recognizing a complete framework for timing entries with greater structure, precision, and confidence. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.